Welcome, everyone. Today, we are elevating our treasury knowledge by looking at how different industries require vastly different banking architectures. Let's get started. Welcome to our masterclass on sector-specific case studies in account management. As a senior treasury professional, I can tell you that applying a standard, one-size-fits-all approach to bank accounts simply does not work. What exactly is account structure design? It is the deliberate, architectural organization of your bank accounts globally. The basics involve making critical decisions about account locations, currencies, and ownership. Why is this so important? Because a flawed structure silently drains enterprise value. It creates trapped cash, balloons your transaction fees, and completely blinds your liquidity visibility. How do we build the right structure? We must rigorously assess our business operating model, the specific types of transactions we execute, and local regulatory laws. In our deep dive today, we will look at how two vastly different sectors, manufacturing and transportation, require completely different architectural designs to function efficiently. Let's start mapping this out. Let's look at the flowchart on your screen, which visualizes the foundational drivers of account architecture. At the top, you see three critical inputs: your business operating model, your transaction flows, and the local regulatory environment. These all feed directly into the central decision node, account structure design. As we move downwards, this design branches into three primary execution vehicles. First, we have local accounts, providing agility and in-country control. Second, we have centralized accounts, serving as the hub for group-level liquidity. Finally, we have non-resident accounts, which are critical for offshore cross-border operations. Understanding exactly how your specific sector maps to these three lower nodes is the absolute key to minimizing operational banking costs and maximizing global cash visibility. Let's dive into our first sector case study, manufacturing. What defines the financial flows of a manufacturing firm? It involves massive sourcing of raw materials and heavy, continuous disbursements for running physical plant operations. The basics of this sector are that it is highly payment-intensive and deeply rooted in local operations. Why does this matter for our bank accounts? Because when you are dealing with local raw material suppliers, factory payroll, and local utility providers, you require seamless, low-cost domestic clearing. Paying a local vendor via an expensive cross-border wire from a central European hub is a waste of money. How do we solve this? We architect local in-country accounts with local control specifically for domestic procurement. Our deep dive reveals that successful manufacturing treasuries physically separate their local operational payment flows from their global supply chain invoicing. This dual approach maintains on-the-ground agility while preserving top-level corporate control. Observe this split flow diagram representing a typical manufacturing setup. On the left, we have the manufacturing plant itself. Notice how its financial requirements split into two distinct paths. The top path handles local sourcing, routing directly into a local in-country account, which then efficiently pays local suppliers and payroll using cheap domestic clearing networks. Now look at the bottom path. For global export and import activities, the flows bypass the local accounts entirely and route into a centralized treasury account. This account manages the global supply chain. This visual perfectly demonstrates how a manufacturing firm must segment its account structure to optimize both local payment execution and global liquidity. Building on the manufacturing structure, how do we actually execute this without adding massive manual workload? We leverage our Treasury Management System, or TMS. What we do is automate the routing of payments based on the account architecture we just built. The basics involve using system logic to instantly differentiate between a local vendor payment and a global intercompany settlement. Why is this critical? Because relying on humans to manually pick the correct bank account for 10,000 invoices a month leads to errors and expensive cross-border wire fees. How is this achieved? We code routing rules directly into the ERP or TMS. I have provided a sample JSON code concept on the screen. Let me explain it. The code looks at the order type. If it identifies local procurement, it automatically triggers the action to fund from the local operating ACC using domestic clearing. The deep dive here is that an elegant account structure is useless without the technical automation to drive transactions through the correct pipes. Let's walk through the sequence diagram to see our JSON routing logic in action. First, the corporate ERP submits a massive batch of mixed invoices to the routing engine. The routing engine instantly parses the JSON logic we discussed. It dynamically splits the batch. It routes the local supplier payments down to the local bank for low-fee domestic clearing, while simultaneously routing the global supplier payments up to the global hub, where foreign exchange risk can be managed centrally. Finally, both banking nodes return settlement confirmations back to the ERP. This is the gold standard for operationalizing a manufacturing account structure. Now let's pivot to our second case study, the transportation sector, specifically focusing on airlines. What defines an airline's financial footprint? They operate and generate revenue in dozens, sometimes hundreds, of global locations. But here are the basics. Unlike a manufacturing firm that sets up separate subsidiaries everywhere it builds a factory, an airline typically operates globally using a single, or very few, legal entities. Why do they do this? Because generating ticketing revenue in 50 countries without having to legally incorporate 50 separate subsidiaries drastically reduces legal, tax, and administrative friction. How do their cash flows work? Their local outgoing payments are extremely limited, usually just fuel, airport landing charges, and local staff salaries. Our deep dive reveals that the overwhelming majority of an airline's cash flow is incoming revenue ticketing collections spread across the globe. Therefore, setting up heavy, locally controlled operating accounts, like we did for manufacturing, makes absolutely no sense here. This mind map perfectly illustrates the airline operating model. At the center, we have the airline HQ, operating as a single legal entity. Branching out, we see operations in Japan, the UK, and Brazil. Notice that under every single location, the dynamic is exactly the same: high ticket revenue coming in, but very low local costs going out, just fuel and airport fees. There is no heavy local supply chain. This visual highlights a massive structural challenge. If you have huge cash surpluses building up in 50 different countries under one legal entity, how do you get that money home efficiently? That requires a specialized account structure. To solve the airline's cash trap problem, we deploy a highly specific banking tool, non-resident accounts. What are they? A non-resident account is a bank account held in a local jurisdiction, but legally owned by an overseas corporate entity that does not have resident status there. The basics are simple. The airline's home HQ owns the account in the foreign country. Why is this brilliant? Because it allows the airline to collect ticket sales in local currency using cheap domestic clearing networks, completely avoiding the legal burden of incorporating a local subsidiary. How does it operate? The airline collects the local revenue, pays its minor local airport fees from the same account, and then sweeps the net surplus directly back to headquarters. Taking a deep dive, this specific account structure mathematically guarantees the repatriability of funds. By concentrating all global net collections into a central HQ account, the airline consolidates the massive liquidity required to fund its heavy capital expenditures, such as international aircraft leasing. Let's trace the cash flow through this non-resident account architecture. On the left, in the foreign country, local ticket sales flow directly into the non-resident account. From this same account, the airline executes its minor local obligations, paying local fuel and fees. Now, look at the crucial cross-border arrow. The remaining balance, the net surplus, is automatically swept out of the foreign country and into the central HQ account in the home country. Finally, on the far right, that concentrated liquidity is deployed to pay for major corporate obligations, like aircraft leasing payments. This is liquidity management at its finest. Having seen both case studies, we must now address the core strategic dilemma in treasury design, the trade-off between effective flows management and efficient liquidity management. What does this mean? It means you have to choose your priority. The basics show us that manufacturing, with its heavy local supply chains, leans towards optimizing flows, making payments efficiently. Transportation, with its scattered revenues and centralized debt, leans towards optimizing liquidity, concentrating cash. Why is there a trade-off? Because it is extremely difficult to achieve perfect local payment agility and perfect global cash concentration simultaneously. One usually compromises the other. How do you decide? You define the primary driver of your business. If your biggest risk is halting a local factory because a vendor wasn't paid, prioritize flows. If your biggest risk is missing a centralized aircraft lease payment, prioritize liquidity. The deep dive realization is that the optimal account structure sits on a dynamic spectrum. You must constantly evaluate if the administrative cost of maintaining local accounts outweighs the savings generated by using domestic clearing networks. This state diagram maps out the strategic fork in the road for account design. From the starting node, we branch left for the manufacturing priority, effective flows. This leads to decentralized local accounts. The inherent trade-off here is high agility, but an increased risk of trapped cash. If we branch right for the transportation priority, we seek efficient liquidity. This leads us to centralized non-resident accounts. The trade-off on this side is high cash visibility, but potential payment friction when trying to execute complex local disbursements. As a senior treasurer, your job is to identify exactly where your company's operational reality sits on the spectrum and design the accounts accordingly. Let's apply these theories to a real-time, highly impactful use case. Consider Global Wings Airways. The scenario: they aggressively expanded ticket sales into 20 emerging markets, maintaining their single HQ legal entity model. The problem was severe. Their revenue was getting trapped in 20 disparate local banking networks. Because HQ couldn't see or access this cash, they were forced to borrow millions externally at high interest rates just to fund their aircraft leases, despite actually being cash-rich globally. How did we solve this? The Treasury team completely re-architected the banking setup. They implemented a standardized non-resident account structure across all 20 jurisdictions, partnering with a single global bank capable of offshore hosting. The execution was flawless. They deployed automated Swift MT101 messaging to physically sweep net balances back to HQ at the end of every business day. The result transformed the balance sheet. They slashed their external borrowing costs to zero, centralized massive liquidity for investments, and completely bypassed the legal friction of setting up 20 local subsidiaries. Review this transformative flowchart. At the top, in the before state, we see the anatomy of a liquidity crisis. Trapped cash in 20 markets results in zero HQ visibility, which forces expensive external borrowing. This is a classic treasury failure. Now, follow the redesign arrow down to the after state, structural excellence. By deploying non-resident accounts linked to daily Swift MT101 sweeps, the airline achieves centralized HQ liquidity. This liquidity feeds directly into internal lease funding, dropping external debt to zero. This use case proves that intelligent account structuring is not just an administrative task, it is a profound driver of corporate profitability. As we conclude our session, it is vital to remember that an account structure is not a set-it-and-forget-it exercise. It requires continuous evaluation. If your manufacturing firm suddenly shifts to a direct-to-consumer e-commerce model, your legacy account structure will become obsolete overnight. Furthermore, you must engage in rigorous regulatory monitoring. Tax laws and capital controls shift constantly, and complex setups like non-resident accounts demand strict, ongoing compliance. Always ensure your bank relationship management is proactive. Your chosen architecture is only as strong as your banking partner's technical capability to execute it. The ultimate goal of account management is to align your banking architecture flawlessly with your physical supply chain and revenue model. By mastering these sector-specific nuances, you ensure that your treasury operates as a strategic liquidity engine, not just a passive cost center. Thank you for joining me today. I invite learners to like, subscribe, and visit quicktechie.com for premium certification prep, including Q&A banks, full ebooks, audiobooks, full-length training, and interview guides. Our final state diagram illustrates the life cycle of account structure sustainability. We begin with the initial design, moving into implementation, and then into the critical monitoring phase. Inside the monitoring state, we are constantly scanning for 3 disruptive triggers: business model shifts, regulatory changes, and bank performance issues. When any of these triggers activate, we move into reevaluation. If the change is significant, we loop all the way back to initial design for a structural pivot. If the structure holds, we achieve our optimized state. This loop ensures your treasury architecture remains resilient and fit for purpose year after year. Thank you for your time, and keep striving for excellence.